All right. Today is Sunday, October 23rd, and this is an earnings review video, not a stock market review. That's coming later. And we're going to talk about the bullshit that happened on Friday with Mary Daly from San Francisco and the Wall Street Journal and all of that. And per usual, it's going to be a members-only video. It's Sunday after all. So if you do have the means to support the channel, go ahead and join the membership program. If not, be kind enough to give us a like, a subscribe, and a comment, and you will find out that this video is already packed with a lot of information. And the reason is, we're going to talk about earnings, aka the bread and butter. It's all about the numbers at the end of the day. When we look at earnings season, the goal is to find stocks to be in, to add to wait to buy the dip into, or to sell, to short, or to think about shorting from this point on. And it's all about the numbers. The numbers are going to lead us to these kind of decisions. Now, we're done with week one, which I consider week one. Earnings actually started before that, but it is the main, or let's say week number one, for the main earnings in the stock market. And the narrative so far is earnings season is pretty good. All of these fears by the bears about a crumbling economy and a loss of earnings, all of these fears have been amplified and exaggerated, and in reality, earnings are pretty good. Once again, we're going to let the numbers talk, not the narrative or the talking heads on TV. And last week, we got a lot of earnings, but the ones I'm going to talk about here in this episode. Last Tuesday, we got Goldman Sachs, Lockheed Martin, Netflix, and United Airlines. And then on Wednesday, we got Procter & Gamble and Tesla. And then Thursday, we got Snapchat. And lastly, Friday, we got Schlumberger, whatever floats your boat. Doesn't matter to me, so long as it prints. And boy, did it print on Friday or what. We're going to cover everything here, so grab your adult beverage, your popcorn, whatever you got. Buckle up your seat belts, and here we go. We start with Goldman Sachs. Now, the headline reads, Goldman Sachs profits down 44%, but they beat the target set by analysts, and therefore the stock moved higher. And of course, there is a restructuring in Goldman Sachs once again. And the reason is, some of their segments are underperforming by a lot. For example, this is the breakdown of segments, revenue by segment for Goldman Sachs last year, same quarter last year. And the two most important segments are number one, global markets, number two, investment banking. Now notice that last year, the share of revenues by global markets was 41%, and the share of investment banking was 27%. Now fast forward a year later, and the share of investment banking in the overall revenues for Goldman Sachs went down from 27% to only 13%. On the other hand, the share of global markets went from 41% all the way to 52%. So what is the reason behind all of this? And the answer is obvious. The stock market is not doing pretty good. It's not doing as good as 2021. And we let the numbers do the speaking here. We will look at the revenues for investment banking, down 26% quarter over quarter, and an even more stunning drop of 57% year over year in the revenues for investment banking. So the drop in the stock market and the slow down in IPOs and M&A activities is hammering Goldman Sachs pretty good. On the other hand, the global market segment was down 4% quarter over quarter, but up 11% year over year. So you can look at it one way as, okay, the revenues are up 11% year over year, but that pace is slowing down quarter over quarter. Now, when we look at asset management, up 68% quarter over quarter, but the number shouldn't fool you because year over year, the revenues for asset management down 20%. And lastly, when it comes to consumer and wealth management, the revenues are up 9% quarter over quarter and a positive growth rate year over year of about 18%. So we got two segments outperforming, global markets and consumer wealth management, and then two other segments underperforming big time, that is investment banking and asset management. All in all, the net revenues are down 12% year over year. On the other hand, the expenses for Goldman Sachs went higher by 17% year over year. The growth rate in revenues is negative. The growth rate in expenses is positive. The gap is so large. This is not going to be good for the net earnings of the company, aka the bottom line. As you can see, it is down by a stunning 44% year over year. Now, when we look at the results by geography, just so we know which regions are outperforming, which regions are underperforming. The Americas down 7.67%, Europe, Middle East, and Africa down 8.8% year over year. And the most stunning one is Asia. Goldman revenues in Asia down 34.5% year over year. Unbelievable. And the question now becomes, why did the stock react positively to such horrendous report? The answer is the stock was down big heading into this report. It was down about 31% from the top. Now, the profits are down 44% year over year. The stock is only down 31%. So some would argue, certainly I would argue, if the downward pressure on Goldman Sachs numbers continues throughout the year to the next quarter and 2023, then this stock should go down and it will make lower lows. No doubt about it. But for now, it was a relief rally because the results not as bad as expected, yada, yada, yada. And we saw a pop higher in Goldman Sachs. Now, the question is, how high could the rally go before it stalls? And this is a weekly chart. So if we use the same chart, it is making a higher low. This is a positive development for the chart right now. So we know that the fundamentals are supreme, but the technicals are also important. The technicals are positive for now, but we have an important resistance at around 347.35. My hunch is we could see the pop stalling right there around this number, and the chart would make a lower high. And then we're going to have the conflict of, look, we have a higher low and a lower high, and this brings a consolidation triangular pattern, and then eventually, in my opinion, the break will be to the downside, because this weakness that you're seeing right now in investment banking, this will continue. The stock market will make lower lows. The Fed is not done tightening. Inflation is not done rising. And when it comes to global markets, we're going to see more and more weakness as the dollar continues to rise higher. And as we see the global recession being played out, if you think about it, it is already playing out in Europe. And soon enough, it's going to play in Asia, and then Latin America, and slowly in North America, and then the Middle East. And those revenues for Goldman Sachs are also going to plateau and then move down. On the other hand, is the company effectively reducing its own expenses right now? You saw the numbers. Expenses are rising higher. Expenses are not going down. And this dynamic will push Goldman Sachs at some point near the future to experience even lower margins than it did in this report. And therefore, I don't see Goldman Sachs as an opportunity to buy right here. I see it as perhaps an opportunity to short once we see this rally stalling and reversing. So I'll keep an eye on 347.35 if the stock doesn't even reverse before that. And then we have, let's talk about Lockheed Martin, LMT. And the headline reads, Lockheed Martin tops Q3 profits estimates, but most importantly, also adding a $14 billion share buyback program. Now, we'll let the numbers speak because, yes, Lockheed Martin is doing a lot better than many other companies in the market right now, but we also have corners of concerns here. Now, when we look at the revenue by segment for Lockheed Martin, aeronautics up 8% year over year, missiles and fire control up 2% year over year, rotary and mission systems down 5% year over year, and then we have space, the revenues are up 7% year over year, and all in all, the net revenue for Lockheed Martin is up by 3% year over year. But the revenue tells one side of the story. At the end of the day, with this inflation, the question becomes, are these companies managing their expenses as good as they're managing the revenues? Because we know they're charging more. That's the easy answer when it comes to revenues. But are they managing their expenses right now the way they should? Because in 2020, 2021, there were no concerns about expanding and hiring more folks and paying more wages because business was booming across the economy, even though it was artificially created by the Fed's printing machine. But now, as inflation has progressed and became more mature, we're seeing the ugly side of inflation, where companies continue to jack up prices, but they get hammered either way when it comes to the bottom line, the net income, because they cannot manage their expenses as good as they're managing their revenue strategy. Now, when it comes to Lockheed Martin, the crown jewel of the company is aeronautics, and the operating profit for the most important segment for the company is up 6% year over year. Now, for missiles and fire control, that's down 8%. When it comes to rotary and mission systems, down 10%. And lastly, the operating profit for space is up 14%. So again, you have two outperforming segments. One of them is the most important one, aeronautics, and then the growth engine of the company, which is space. Yet we have two underperforming segments, missiles, fire control, and rotary and mission systems. And all in all, the operating profit for the company is flat year over year. slightly up, but pretty much flattish. And this is actually becoming really hard to do for any company in this economy, to keep a positive operating profit and operating margins year over year. So for a company to actually achieve that, given all of these circumstances that we have in the economy with inflation, or be it the recessionary risks and pressures, when you have a company that has a flat operating profit year over year, that is considered good in this environment. But even with this outperformance by Lockheed Martin, when we look at the consolidated operating profits, they're actually down 6% year over year. And when we look at the operating margins, my favorite, which is basically how much the company keeps in dollar terms for each dollar they generate in revenue. So for example, if it is 10%, the company keeps 10 cents out of every dollar it generates in revenue. They keep 10 cents in profits. And we're talking about pure operations. We're not talking about taxes, depreciation, all of that. When we look at the operating margin year over year, it's slightly down for Lockheed Martin. It went down from 11.5% last year to 11.2% this year. And the operating margin, once again, is down across the board for all segments with exception of space. So yes, the report was good, but we have pockets of concern here. Yet investors remain positive in Lockheed Martin, including myself, because what's coming in the pipeline. Forget about the lagging indicators, what happened last quarter. It's about what's going to happen. The replenishment of all of these weapons and systems that we sent to Ukraine, the weapons and the systems that we have to send to the allies in Europe and other countries that are now interested in buying these jets from Lockheed Martin. All of that is more money coming toward the company. Not to mention, of course, all of the talk that we have in DC right now that we might see for the first time ever, a $1 trillion defense budget in the United States. A lot of that money will go to the pockets of Lockheed Martin. And no wonder why the company has a lot of cash flow. And so far, it has been returning cash to investors, be it by buybacks or my favorite, dividends. I like dividends better than buybacks because buybacks, in my opinion, don't benefit the shareholders. They benefit the executives and the C-suite to dump shares at a higher price via a pump and dump scheme conducted by share buybacks. Dividends are the way to go, but we have taxation problems when it comes to that for both the company and investors, and therefore some people prefer share buybacks over dividends, but not the guy you're listening to right now. Regardless, the company returned for the year so far, 2022, they have returned about $6 billion back to investors, be it in the shape of dividends of about $2.25 billion or via share buybacks of about $3.7 billion. All in all, the company has a healthy cash flow, and when we look at the outlook, what really excited investors this week to buy shares of Lockheed Martin, but most importantly, force the shorts to cover, because we had a lot of shorts saying, hey, the war in Ukraine is going to be over, peace agreement, the Russians are going to lose, the Ukrainians are going to lose, whatever the outcome is, the bet was we're going to have an end to the war, and this will be bad for Lockheed Martin. Now, they've been seeing the shorts. They've been seeing that their thesis is not really working. The war is escalating by the day, number one. And on top of that, now, number two, we have a giant share buyback program that is double the prior outlook. And therefore, we have seen a lot of short covering in LMT this week. And the bet is the stock will make higher highs. When we look at the chart for Lockheed Martin, this is a weekly chart, we have a giant bull flag consolidation pattern. And now it appears that this bull flag is playing out. We have yet to receive a confirmation from the MACD indicator that this is indeed the end of the bearish momentum and the start of a new bullish momentum in which LMT will make higher highs. The confirmation would be a green impression on the histogram for the weekly chart, giving us a confirmation that this is exactly what's going to happen. But folks, I've been saying this all along when I covered this chart repeatedly in the past. When we look at the MACD indicator for any chart, specifically a weekly chart of any stock, it doesn't matter what it is, if the chart ends a bullish momentum and enters bearish momentum, and you start to see these red columns on the histogram of the MACD, if the chart flushes down right away, that means the chart was weak to begin with and it doesn't have any legs to stand on. Perhaps the rally was built on a short squeeze, a gamma squeeze, whatever it is. And also, if the chart reacts by a significant pullback, that is yet another indicator of weakness. But if the chart resolves the bearish momentum in the MACD by consolidating in a positive pattern, just like Lockheed did, this is yet another sign of relative strength. And therefore, once the bearish momentum is over, we see a sizable reaction to the upside. This is exactly what we're seeing here with LMT. When we look at the monthly chart, this is unlike any other chart we're seeing in the market right now. Pull a chart of the SPY, the S&P 500, or the Dow, or the NASDAQ, it doesn't matter what it is. Nothing looks like this. This is one of the last bullish charts remaining in the stock market right now. And the assumption is, even if we have a relief rally coming, ahead of the elections, ahead of whatever the reason is, pivot optimism once again, you want to be with the winners and the outperformers year to date, not picking up trash and catching these massive rallies, 7, 8, 15% in a day, and then you go down big again. We're talking about stocks like Carvana, for example, the RKK types. But you have a year-to-date winner in Lockheed, despite all of the pullbacks so far. The chart never really violated the trend line. It never really made a lower low. It continues to keep making higher highs. What's not to like here? Next, let's talk about Netflix. What's going on here? The headline reads, and I love these headlines. They give no context whatsoever, but they say Netflix crushes expectations across the board and adds 2.41 million subscribers. Once again, let the numbers do the talking. We'll look at the revenue growth year over year for Netflix. In the third quarter of this year, it was up about 5.9%. But notice the trend here. Last quarter was 8.6%. The quarter before that, it was 9.8%, and before that, it was 16%. I'm going to illustrate this to you in a chart in a minute, but when we look at the operating margin, it was about 19% the third quarter in 22. But what's really stunning to me is the fact that they say in Q4 of this year, the operating margin will go down to 4.2%. That is absolutely abysmal. And by the way, all of these estimates for Q4 are fluffed up, and Netflix admits that. I'll show you that in a minute, but here's the chart that I want to show you, and notice the trend here. The black column is revenue growth, red column is subscriber growth. Notice the trend since Q3 2021 all the way till the estimates that we have right now, the forecast for Q4 of this year. The trend is down for revenue growth. In Q3 21, it was 16.3%. Year over year, and according to the forecast by Netflix in Q4, the revenue growth will be reduced from 16.3% all the way down to 0.9%. Are you now surprised by the fact that Netflix stock went down big from the top? Well, the market was already seeing this ahead of time. Likewise, when we talk about the subscriber growth, it was 9.4% year over year in Q3 2021, and the outlook for Q4 of 2022, the subscriber growth will go down to 2.6%. And even more alarming, the net income, aka the bottom line, and the company says in Q4 the net income will be $163 million. This will be down from $607 million a year before. In other words, a decline of 73% year over year in the bottom line of the company. But the good news here is the free cash flow for the company is actually positive. For the past quarter, aka Q3 2022, the free cash flow was positive, $472 million. This is a lot better than many years where the company had negative cash flow. Of course, they reported a massive positive cash flow in Q1 of this year for about $800 million. So this is the good news for Netflix. But all of this cash flow will go into spending and expenses, and the margins for this company will continue to go down quarter over quarter, year over year. And this is perhaps the most alarming fact when it comes to the earnings of this company. This is how they report. They give us the Excel sheet, but it's really helpful even though it looks complicated. In reality, it's not. All what we have to look at is the paid memberships by the end of the period. In North America, for example, US and Canada, by the end of the year 2020, the growth for paid memberships was about 6.2 million new members. That rate of growth slowed down in 2021, yet be it positive, at around 1.2 million subscribers. However, for this year so far, Netflix has lost about 1.8 million subscribers in North America. Now, we have one more quarter to go for the year. Can they make it up and add over 2 million subscribers magically by the fourth quarter and have a positive growth rate for the year? Highly doubtful. In other words, it appears that this company has hit a ceiling when it comes to the growth in subscribers, which makes the company now a cash cow. The avenues for growth are shutting down, and the only avenues left are milking the subscribers that they currently have for more cash. Of course, for now, Netflix is doing this cute strategy, or should I say tragedy, of doing ads. You pay $7 a month and you watch a bunch of ads. That's all trash. It's not going to work. The only way for Netflix as a company and as a stock to continue to perform and continue to be looked at as a growth company is to charge more and more and more and then even more. That's the only way. Because when we look at Europe, Middle East, and Africa, again, the subscriber growth was absolutely stunning with about 15 million new subscribers in the year 2020. This rate of growth slowed down to about 7.3 new million subscribers in the year 2021. Well, guess what's happening right now? So far for the year, Netflix is actually down about 500,000 subscribers in this region. Can they make it up by the end of the year? Can they go positive? Sure. But there's no doubt that the growth rate in subscribers is stalling big time. Now, when it comes to Latin America, in 2020, the company added about 6 million new subscribers. In 2021, they added about 2.5 million new subscribers. Now, so far for the year, the company's down about 25,000 subscribers in Latin America. Again, can they make it up? Sure they can by the fourth quarter, but there is no doubt that the growth rate is slowing down big time. Asia Pacific added about 9.3 million new subscribers in 2021, or 2022 I should say. In 2021, added about 7.1 million new subscribers. So far for the year, they have added about 3.5 million subscribers in this region. The only region with positive growth in membership. However, the most important finding from all of this is the currency impact. Look at this. Absolutely stunning. Look at the Europe, Middle East, and Africa, for example. The company should have reported a positive growth rate in revenues of about 7% year over year, but due to the strength of the US dollar, this growth rate went down to minus 7% year over year. The dollar absolutely wrecked the revenues entirely, and then some. When it comes to Latin America, the company should have reported a positive growth rate in revenues of about 16%, but due to the strength of the dollar, this positive growth rate went down from 16% to only 9% year over year. And on top of that, when it comes to the Asia Pacific, the revenues should have been down only 3% year over year, but due to the currency impact and the strength of the dollar, the revenues went down by 13% year over year. In other words, the dollar is wreaking havoc on the earnings and the revenue growth from Netflix. And here's the most important part and why the worst is yet to come for this company. In the report, they say, as a reminder, this is the footnote, the catch, our 2022-2023 operating margin target of 19 to 20% is based on the FX rates in January of 2022. Whoops. With the appreciation of the US dollar, though, our operating margin would be lower than 19 to 20%. Oh, you think? I bet it's going to go negative because look at this. Since January of 2022, the dollar is up about 23.5%. I bet Netflix will bomb the next report big time and the stock will go down because so far the stock is actually up since the bottom. We're not sure it is the bottom for now. Regardless, the stock is up a stunning about 77%. When you put it in perspective though, since the top, Netflix is down about 58.5%, and that is despite the recent surge. Now, we have resistance at around 290.25. These are my numbers, of course. And the next resistance would be at around 346.18. I doubt that the chart's going to blast above this number easily. It's not going to happen. It might even pull back before that. Again, if the dollar continues to move higher, bad news for this company. On the other hand, if the dollar starts to ease, you might see a relief rally in Netflix continuing all the way until we get the actual numbers for Q4. But for now, as it is, as the US dollar is standing right now, it's going to be a big miss for Q4 by the company. Next, let's talk about UAL, United Airlines, and the headline says, United Airlines expects another profit as travel demand continues to recover. Everything is hunky-dory, right? Here's the problem. Again, we're going to let the numbers do the talking here. When we look at the operating revenue for the company all in all, and by the way, thank you for United Airlines for reporting the numbers versus 2019 because this is what really matters. We cannot really pin these numbers that we got in 2022 with 21 or even 2020 because we got the lockdowns. You know the story. So what we're trying to find out here is the company and the airline sector in general. Are they recovering 2019 numbers or not? When we look at the operating revenue for United, for example, it is up 13.2% versus 2019. So far, so good. Here's the problem. When we look at operating expenses, the number is up by 15.3% versus 2019. So once again, you have a growth rate in expenses of 15.3% versus a growth rate in revenues of 13.2%. The growth rate in expenses is surpassing the growth rate in revenues. In other words, this is not sustainable. Either the company has to continue to jack prices higher to increase the revenue. The question now becomes, will the consumer be receptive to higher ticket prices even if we head into a recession? And most importantly, will the expenses for the company go down? Can they reduce the expenses when they're paying top wages, inflated wages for all the pilots, the mechanics, the flight attendants that they got rid of due to the mandates and now they want back? They have to pay them more. They have very little wiggle room here when it comes to expenses. In other words, this is not good. But more details for you. When it comes to aircraft fuel expenses versus 2019, this number is up 63.5%. When it comes to aircraft maintenance and materials and outside, this number is up 26.3% versus 2019. All in all, the operating margin back in 2019 was 13%. And despite the rise in revenue versus 2019, the operating margin this year is down to 11.32%. Here's another problem for this company. It's not just the fact that their ability to continue to raise prices is limited, or even the fact that their ability to decrease expenses is limited too. We also have another phenomenon where interest rates continue to move higher, and these companies, be it airlines or cruises, happen to be heavily in debt. So when we look at United Airlines, look at the interest expense this year versus 2019. It is up by 138.2%. And once again, despite the rise in revenue, when you factor all of this in, the net income, the bottom line for the company, is actually down 8% versus 2019. So whatever rally we're getting right now in United Airlines and any airline stock, my hunch is it is a relief rally that will frizzle out sooner or later. Because for now, the bulls and airlines, they would say, look, these stocks are overbeaten. They never really recovered the pre-pandemic drop, or the pre-pandemic levels, I should say. And the market has been extremely harsh on these companies. Yet the numbers are not really that bad when you look at it versus 2019. They are recovering a lot. So shouldn't this stock go higher? Shouldn't this be an A, B, C pattern, and the chart makes higher highs, maybe all-time highs when it's all said and done, let's say by 24, 25? In my opinion, the fundamentals don't support the technicals here. The fundamentals say that these companies will face a lot of problems once we see interest rates continue to rise higher, yet inflation is not abating. Therefore, the fuel cost, the expenses for this company will continue to hold on and be sticky. On the other hand, as the Fed continues to slow down the economy, we're hearing about more and more and more layoffs. When folks lose their jobs and the economy starts to sour, they're not going to travel as much. And certainly United Airlines is not going to be able to maintain the pricing advantage. You put it all together, stay the hell away. Every rally right now, you wait for it, let it play out, and then it's going to present itself as another shorting opportunity. Next, we have Procter & Gamble, another consumer staple giant. And the headline reads, P&G's pricing strategy saved the quarter, but the dollar's strength could ruin the year. Pay attention now. What is the theme here? We got all of these companies struggling with inflation, and the response is to continue to jack up prices higher and higher and higher until something breaks, until the consumer says no mas. We cannot really keep with these prices moving higher. And the consumer is not going to say no mas until they start losing their jobs. And they're not going to lose their jobs until the Fed becomes even more aggressive in tightening the monetary policy. And the Fed is not going to be even more aggressive in tightening the monetary policy without another inflation shock, which is coming. Wait till the next CPI. In any case, the numbers for P&G. Net sales were up 1% year over year, yet the cost of products sold was up by 5% year over year. On the other hand, expenses were down 2% year over year. So we have a company here that is seeing some increase in their revenues, not because people are buying more, but because they're charging more on these products. On the other hand, despite all of this strategy is not really working as much as it should, and they need to increase prices even more because the growth rate in the cost of these products that they're selling is up 5% in the same period. So expect higher prices for Procter & Gamble products as a consumer. Yet the company is being really good in managing their expenses. They managed to drop down expenses by 2% year over year. But even with all of that, the dollar and the rise in yields and interest rates is going to crush all of these companies. There's no way they can cope with this. They have to raise these prices astronomically. And at some point, the consumer is going to break and say, no, I can't do it anymore. Yet the company is stuck with the inflationary costs, the input costs they have to pay for these products to be produced and delivered. They're stuck with the rise in interest rates. Look at the interest expense for the company going up by 13% year over year, and therefore the net earnings for the company, the bottom line, is actually down 4% year over year. The company is also stuck with a higher dollar. Look at the different segments for Procter & Gamble. Be it beauty, grooming, healthcare, doesn't matter. The strength of the US dollar shaved off about 6% on average from each category. And to counter all of that, you see right next to it, the column of price, the company has to increase prices by more than the negative impact by the US dollar. So you see the volumes are negative. People are not buying more. And on top of that, the dollar is hammering these earnings. So they have no other choice but to continue to jack these prices higher. So when you hear on TV, today I was watching TV, the Sunday shows, and you got Bernie Sanders on CNN, and he said, look here, this inflation is not the Democrats' problem, it's not the Fed's problem, this inflation is due to the price gouging. And I say, Senator Sanders, the price gouging is happening because these companies have no other choice but to continue to raise prices higher. Otherwise, they're going to lose money. And when they lose money, they're going to lay off employees. It's the way it is. That's how inflation works. And when we look at the operating margin for Procter & Gamble, it went down from 24.7% last year to about 24% this year. Now, you might say that this is not a big deal, but in consumer staples, in these kind of companies, as small as the drop might look to you and me, the negative impact from such a drop is immense for companies like Procter & Gamble. And here is the weekly chart for the name. It blasted higher initially after the report was out, and then it gave up the majority of the gains by the end of the week. And my hunch is when we use the Fibonacci retracement levels, this chart will make lower lows, no doubt about it. Whether it's going to make it right now or after rallying even further, that doesn't matter. At the end of the day, the chart's going to go down and it will make lower lows. No doubt about it. Now, when it goes down and we have a recession, it might present an opportunity to buy the stock because Procter & Gamble and the majority of consumer staples companies tend to outperform when it comes to the recession because the consumer has no other choice but to buy from these companies. But the recession is good for them because the recession doesn't happen until inflation is gone, or inflation is reduced at least, and reducing the cost of inflation, plus Procter & Gamble perhaps maintaining some of the pricing power they enjoyed during inflation. When the recession happens, that would be a positive dynamic for the company to outperform when the recession happens. Next, we have Tesla, the souffle, and here is the report that we got from the company. Automotive revenues up 55% year over year. Revenues all in all, and by the way, just a point, a lot of critics of Tesla, including myself, we used to say, hey, the revenues are bullshit because the company is making the majority of their revenues from the regulatory credits. Not anymore. The company managed to silence all of these critics, including myself, because the regulatory credit contribution for the overall revenues for automotives is actually down to a negligible 3%. But anyways, the all-in-all revenues for the company up 56% year over year. Expenses are up only 2% year over year. The operating margin is a stunning 17.2%. You're never going to see these kind of numbers from GM, Ford, any of them. When it comes to the net income for the company, once again, a stunning growth of 103% year over year. And perhaps even more stunning, the free cash flow for the company is up 148% year over year. Now, I know what you're thinking. You're saying, hey, Maverick, what are you saying? Tesla's good now? You happy with these numbers? These numbers are pretty good. Here's the problem. Remember what I said about Tesla, that it's all about the growth of the company, the growth story. Is it intact? Is it not intact? Because the stock, the problem is not the company. The problem is the stock. The stock is pricing in a fantasy. It is the most overvalued stock in history for a company this size, but everybody was willing to hold their noses and say, okay, we'll tolerate this insane valuation so long as the growth of the company remains intact. What did we get this quarter that gave us a confirmation that the growth story for this company is actually slowing down big time? The answer is automotive gross margin. which is one of the most important metrics in the automobile industry. And this quarter, this margin was down by 258 basis points. To put it in perspective, let's look at the automotive gross margin for Tesla since the first quarter of 2021. As you can see, this metric has been rising all the way till Q1 of 2022 when it peaked, and then it started moving down. And last quarter when it went negative, everybody said, okay, this is due to China, the lockdowns. It's a one-quarter phenomenon. The Shanghai factory was down. You know the story. And the market said, okay, we'll pretend that this is not a big deal. We'll say this is a one-quarter thing because of China and the lockdowns. But now we got the confirmation. This is not just about the lockdowns. This is about a slowdown, a legitimate slowdown in momentum. The trend is clear. The automotive gross margin is now down to a negative 258 basis points. This is stunning. And you know what even more stunning? Look at this chart. This is Tesla, a line chart, weekly chart. It is almost a mirror image of the chart of automotive gross margin. And if the correlation holds, oh boy, this chart of Tesla will make lower lows in a big way. Next, we have Snapchat, and what a disaster this was. Why was it a disaster? Let's look at the numbers. When we look at revenues, the growth year over year, by region, globally, it was up 6%. North America was up 3%. Europe was up 5%. The rest of the world was up 22%. So what is the problem here? The revenue is going higher across the board. Likewise, when we talk about the average daily users, which used to be a metric that the market really liked and concentrated on back in the QE era, nobody cared about revenues or profits. Mostly profits, nobody cared about that. The market cared about the growth in users. And we will see stocks like Snapchat popping higher once we get a report that users moved higher. Same for Meta, used to be Facebook, you know the story. But now QE is over, and here comes QT. And the question becomes, the market doesn't care about the growth in daily users. The market cares about the top and the most important bottom line. When it comes to daily users, up a stunning 19% year over year for global users. North America up 4%, Europe up 11%, rest of the world up 34%. No problems here. But here's the problem. It doesn't matter how many users the company is gaining if that's not translating to more money and more revenue. When we look at the average revenue per user, down 11% globally, down 1% in North America, down 5% in Europe, down 9% in the rest of the world, and it gets even better. We look at the margins for the company, expenses and all of that. If they're not making more money by acquiring more users, then what is the point? Especially when they're actually getting more expenses per user, but not more revenue. Overall, the adjusted operating expense margin is down year over year from 57% to 46%. On top of that, when we look at the adjusted operating expense as a percentage of revenue, last year it was 43%. This year it is up to 54%. So the operating margin for the company is going down. In plain English, they're making less money from each dollar they're generating as revenue. They're keeping less and less from that dollar as profit. Now, when we look at the composition of expenses for Snapchat, and this is really important, what was the reason behind the increase in expenses which pushed the bottom line, the net income, down big? We can see that the growth rate year over year for research and development is up 34%. The expenses for R&D up 34% year over year. For sales and marketing up 23% year over year. And this is the most important one, for general and administrative up 37% year over year. In other words, now that the company is generating less cash from each user acquired, they have to cut down on expenses. When we have general and administrative costs moving higher by 37% year over year, that is a problem. What are you saying here, Maverick? I'm saying if you happen to work at Snapchat, you better have an exit plan because your ass is getting fired. No doubt about it. Because look at this. The operating loss for the company is up 141% year over year. Once again, the operating loss, not the operating revenue. The loss is up 141% year over year. And it gets even better when we talk about the net loss, the all-in-all loss, up 400% year over year. The free cash flow, that is down 65% year over year. Folks, this is a company that is imploding, and with interest rates moving higher, with the dollar moving higher, forget about it. This is a company that will go down big. If you thought that the crash in this stock is over yet, think again. The stock is down about 90%. It lost about 90% of its value since the top. And back then, the valuation of the company was an absurd $113.3 billion. Now, the company generates it has been generating about $1 billion worth of sales, let's say for the last couple of years. In other words, back then, if you bought Snapchat shares, you were paying about 113 times the amount of revenue the company generates in a year. 113 times sales. That is delusional. That did not make sense back then, and it certainly doesn't make sense right now. The valuation right now is down all the way to $12.5 billion. Now, sure, the company generated about $1 billion in sales last year. So is it worth it to pay 12.5 times sales? I don't think so. Number one, the revenues will continue to go down because we have more competition, be it from Meta, be it from TikTok, most importantly, and the company is generating less revenue per user than ever before. Number two, the expenses are too high, and that means that the bottom line for the company will go even down. So forget about what you're paying right now as a price to sales ratio. What are you paying as a price to earnings ratio? Number three, the company has a high debt on the books, and as interest rates continue to move higher along with the dollar, their margins will continue to get worse and worse and worse. In other words, the $12.5 billion in valuation right now, that is way, way too rich. The valuation should go down, and this is still generous, by the way, to about $5 billion. And lastly, let's move on to SLB Schlumberger. Now, we know that oil and gas is the last remaining bull market, and the results say exactly that. When it comes to the revenues for Schlumberger, and notice the difference here between a company like this versus Snapchat versus Netflix or even Procter & Gamble. The revenue quarter over quarter up 10%, year on year up 28%. The net income down 5% quarter over quarter, but up 65% year over year. Now, when we look at the revenue by geography, up 13% for internationals quarter over quarter and up 26% year over year in international markets. But in North America, the growth rate is 0% quarter over quarter and then 37% growth rate year over year. We'll expand more on the geography in a minute, but before we do that, let's do the segments, and when we look at digital and integration for the company, the revenue for this segment is down 6% quarter over quarter, but up 11% year over year. The reservoir performance division is up 9% quarter over quarter, and the revenues are up 22% year over year. And the most important segment, well construction, is up 15% quarter over quarter and a stunning 36% year over year. Now, when it comes to production systems, that's up quarter over quarter by 14% and 28% year over year. So far, so good, no problems here. We don't see this kind of growth year over year or even quarter over quarter in any other company in the market besides oil and gas. With that being said, are there any pockets of weakness in this company? The answer is perhaps. And this comes from the digital and integration division. When we talk about the operating income, it is down 20% quarter over quarter, yet maintaining a positive rate of growth of 7% year over year. When it comes to reservoir performance, the division is up about 25% quarter over quarter when we talk about the operating income and 28% year over year. And when it comes to the well construction division, the operating income is up 41% quarter over quarter and a stunning 92% year over year. And lastly, when it comes to production systems, the operating income is up 31% quarter over quarter and 36% year over year. But you know I love the operating margin even more, and the growth rate is positive in operating margins across all of these divisions, and it is positive for the company quarter over quarter and year over year. Yet the only weak pocket for this company remains the division of digital and integration. The operating margin for this segment is down quarter over quarter, and it is down year over year. But all in all, I'd rather be in a name like this versus taking my chances in calling the bottom in Netflix or Snapchat or even buying the dip in Procter & Gamble. When we look at the geography and compare this with Goldman Sachs or even Netflix and see which company is outperforming across the board, in North America year on year, the growth was 37%, Latin America 30%, in Europe and Africa 38%, in Middle East and Asia a growth rate of 15% year over year. The company is doing great. The growth is stunning, and therefore it is no wonder why the stock shot up higher on Friday by over 10%. Now, here's what I said about Schlumberger in the past. Let's take a look. Next, I have the ticker SLB. Everybody's now looking at oil futures, perhaps bottoming and moving higher again. All of a sudden, we have a stampede to re-add these positions back into our portfolios. Instead of buying oil futures or ETFs, I'm looking at the gasoline RBOB. It's still down. On the other hand, we have crude oil futures moving higher. So a processor will be the right play here. They benefit from the lower prices of gasoline or bob. Their input cost is down, but they can still charge higher prices because crude oil prices are moving higher. So I see an opportunity here in this weekly chart of SLB. It is maintaining the trend line, and we have two targets here. Target number one, the top of the breakdown candle for around 45.32, and then closing the gap at around 47.21. And here's the update. The stock went down initially in a revisit to the trend line, and my original thought was if it goes down to the trend line and it breaks the trend line, then I'm wrong and let's abandon this trade and say goodbye. But the chart managed to keep the trend line and bounce beautifully from the same trend line and then make higher highs. That was right away a sign that this chart is not going down and it's actually waiting to blast higher. And the chart blasted above all of these targets and numbers and made a higher high. So where is the next stop for this name? If we zoom out, we have number one, a resistance that the chart already defeated on Friday, which is 48.88. It might go down in a revisit and recheck to that particular number, but if it does and passes it successfully, or if it continues to move higher, we have the next resistance at around 54.79. The valuation on this stock is absurd in a good way. It is severely undervalued. You look at the growth rate, you look at the numbers that the company is producing, be it in revenues, top line, or the bottom line, or even the margins. It is a crime that this stock is trading at these levels right now. And with that, folks, this is the wrap up for week number 1 in earnings, Q3. We got another slew worth of earnings coming out this week. The most important ones, the big cap technology names, we'll talk about them and a lot more in the regular program. But for now, this is all I got for you. Thank you for listening. Thank you for watching. And I will talk to you again soon. Take care.
Nice.
Setting time to target, 2 minutes, 15 seconds.
2:15, that's impossible.
File attack point. Mavericks inbound.